is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Without further ado, let's go ahead and bring my man Ryan on the stream. Ryan, how are you doing today?
Good, Aaron. Thanks for having me back. It's been a little while. I know we've both been sort of crisscrossing around the globe, and good to be back in Europe for me and on your show for you.
Yeah, it's great to have you back. And a lot has happened since you were last on the show. You guys ran a whole predictive AI track at the Future Proof Wealth Management Retreat in Colorado, and recently launched a new IP fund that is valued at over 470 million. Excuse me. Can you tell us a bit more about this and what this IP consists of?
Yeah, I mean, we've been talking for a while about trying to give more direct access to the predictive AI-based IP that we build. And one of the things that we came up with about a year ago was using sort of this novel Cayman Islands closed-ended fund instead of like a regular PE offering, and inviting qualified purchasers and accredited investors into the fund. And then that would allow them to directly buy into the intellectual property that we build instead of just benefit on the endpoint from the trading systems that we implement within funds that we manage. And I mean, because there's been this obvious awakening in AI over the last 18 months, the interest has been fairly substantial. It's been kind of hard to keep up with, but I mean, I was surprised. There were like a lot of small RIAs that I totally didn't think would be interested that were, hunting us down at Future Proof to have these conversations. It's pretty fascinating.
Yeah, I mean, that's amazing to see that the demand is there, even from the smaller retail, or even from the smaller, kind of wealth manager advisors, want to still get into AI. It's not just the big boys. Last month, Ryan, we talked about the nature of predictability in the market. This week, we're focusing on what AI can really do in finance. Firstly, what benefits can AI bring from an investment opportunity sourcing perspective?
I think it can do a lot, but I think it's important to differentiate between generative AI and predictive AI in this space. So, generative AI, what can it do for you? It can do a little bit of heavy lifting. It can collect some information, but in terms of delivering a high degree of certainty in any area that you would be comfortable basing an investment decision off of, no, it's not there. I mean, you want to test that for yourself. Go to GPT, ask GPT to build you a robust all-weather portfolio, and then look what it suggests. Like, that breakdown is going to be just batshit crazy. So, it's not going to do that for you, but go find me all the 13 Fs or 13 Ds that have exhibited the following criteria in the last 10 years. It can find most of them, so that's fine. Predictive AI, on the other hand, which obviously I'm a little biased since that's what we specialize in. Predictive AI is very good at finding signals in the noise. That's what it does. It's ingesting, or at least the type that we're using, the entire market at the tick level every single day simultaneously. So you've got 220 terabytes of historical data. You have billions of daily examinations. You have trillions of total transactions, and it's seeing everything in real time. So it's going to be able to pick up on signals that, we humans, no matter how good we get or how observant we are, we just can't get that observant. We can't watch everything all at once, especially, relative to each other. You're watching a sector that you're passionate about, or you think, you're deep, or you think has a future, you're involved in, whatever it is. You get your little micro charts up on a 4x4 panel. Like, you can't watch like all the prints of all of those stocks at exactly the same time to determine where bias is appearing. So AI can do that, and that's powerful.
What differentiates this approach from how a human may look to spot these trends, and what are the challenges in training AI to identify these market trends?
It's a really good question. So ultimately, what we're training the predictive AI to do is find the result of a human investment decision. So if you take a step back, you think about it. every investment decision that's made by any investment manager, it doesn't matter whether it's Ray Dalio or the late Charlie Munger or whoever, right? You don't need to be a fly on the wall of their boardroom. These investment management decisions will result in a trade decision, right? At the end of the day, an accumulation or distribution of an equity or combination of equities, there's a profile that's constructed. So you don't need to do the fundamental analysis that went into this decision. You simply have to find it in all of that noise. So that's what you're reverse engineering. Huge trillion-dollar asset managers are not going to put these orders up lit. And even if they put up unlit, they're going to post a consolidated tape after 7:30 at night. You could find them then. So we're not able to do that. Humans are not able to reverse engineer that trade management decision. So we're trying to review sentiment, try to shift bias. Like, where are we seeing high volume correlation? Where are we seeing volume pressure at price? And we're doing our making our best guess. But predictive AI is able to do this at a scale and at a level of immediacy that we can't. And so, we're not bringing our bias into this. This is simply looking at, is the pattern there or is it not there? It doesn't really give a shit what the actual equity does, what that equity is, what the business does, what are its long-term, who cares? The pattern's there, and following this pattern, this happens most of the time. I'm going to take that down. So that's sort of really key to how that works.
It makes sense. Given human intelligence is needed to train AI, Ryan, how can we look to achieve more accurate results in these areas that push beyond what human intelligence can achieve?
Well, I think it's important to be careful about attributing too much capability to AI when it comes to innovation. AI is not good at that at all. So if you just black box it, you tell an AI system to, quote unquote, go make money, it will do some fairly insane things. It will allow, for example, like a 90% drawdown if at the end of a 10-year time horizon, it makes 35,000%. It's like, yeah, but I made 35,000% in 10 years. It's like, yeah, but you lost almost all of it twice. There's no sentiment there. It doesn't really care. It's like, yeah, whatever. But I scored in the end. We don't do that, right? There's no investor that's going to sit there and say, yeah, I'm cool. I'm cool. The model says that a 90% drawdown's fine. I'll just wait this one out. You'd be having a heart attack, right? And, tying that in, its limitations to what, one of the viewers here, Mike, asked. It's not a standard robo trader, and it's not intuitive. No, it's not intuitive at all. What these systems are able to do is they're able to rewrite portions of their own code relative to the criteria that they've been tasked with weighting. So let's say you're talking about like a dip strategy. Obviously, we have a product that does that. And so it's looking for a specific pattern that precedes a low to high mean reversion with a high degree of certainty. And when it sees the pattern, it takes it down. Now, over time, the 70 different indicators that it's looking at, the different criteria are weighted a certain way, but as markets change, participants come and go, that those criteria probably aren't weighted in exactly the same way. These over here are less correlated with positive outcomes. These over here are more correlated. And so it will shift within the ideology, but yeah, it's not intuitive. It's not like, this is why it's terrible at global macro, right? Russia invades Ukraine. There's no AI that says, well, here's how I think the world's going to respond to that. No chance. Still needs us for that, and needs us to generate the initial strategy. It then takes it, refines it, and makes it more profitable. That's its power.
Ryan, using Kaiju's investment products as an example, can you provide tangible examples of where AI has enhanced human decision making?
Sure. So if I was to, I'll pick a strategy that we use, or two strategies. So we have a complementary pair of complex option strategy. One is called BEX, the bilateral equity corridor strategy. The other one's called RS2. And they predominantly do different things. So BEX is designed to trap price in between 2 points. It it profits off of passive premium acquisition. RS2 profits off of massive oversold high vol conditions reverting to the upside. These were profitable strategies for us years and years ago when we were manually managing hedge funds. And, we were able to achieve in the 3% per month range in optimal conditions, which is fairly substantial, right? So, you're talking, 36% by the end of the year. But once we trained the machine was able to do almost double that. And the reason it was able to do double that was, well, there's two reasons for that. Number one, it was able to weed out candidates that we may have traded that looked good to us. And it's looking at a deeper level. And it's like, nah, I'm going to put that in a tier 3 category. That's not going to be a winner very often. Okay, so less mistakes, number one. And then number two, it's slightly altered the construction of the spreads in both strategies, the option spreads. It skewed on the corridor strategy. It skewed them slightly. It added a long unit. So you give it the capability to refine while still being true to the ideology. At the end of the day, it didn't build a different strategy. It still achieves what we want to do within the risk parameters we set, the way we told it. It just sort of comes back and goes, yeah, I kind of figured out a better way to do that. And that's been shocking. Every time I've seen the refinement, it's just shocking. And I can't think of any way we could do that as humans.
Yeah, that's so interesting. I mean, just figuring out where it has these use cases. In past conversations, Ryan, you have emphasized that AI is meant to complement human intelligence, not replace it. What areas of the investment process do you believe human intelligence is still required as AI strategies start to become more common?
I think there still needs to be an initial sanity check with respect to the ideology that you're trying to follow, right? Like when you build a trading strategy, you're trying to capture something that repeats. You are trying to identify companies that are whose stock is about to roll over, right? If you're a short seller, you're looking for a massive overbought condition, which is just unsustainable, and there's a pattern that repeats, so you can short it. Or you're buying dips, or you're trapping price, or you're shorting or long vol if you're an options trader, volatility arbitrage, etc. And so the ideology matches different global macro conditions. Like trying to corridor price in the middle of the pandemic was like a terrible idea, right? It's not just going to go sideways. That's a market condition where it's not going to go sideways. Now, the machine, once the pandemic gets going, realizes what market condition it is. But as it started, we all knew how unusual this was. You'll press the pause button. You're like, whoa, maybe I'm going to sit in cash for a little bit, and then I'll move back in. So the machine's not great at making those decisions right now. It's like, hey, opportunity, I think I'll take it down. Completely oblivious to what's going on further out in the world.
Right.
So we still need we need to be the guardians there. Where we need to be more comfortable letting go is, we get asked all the time. It's like, oh, but you guys, you double check the portfolio rebalances that the machine's recommending. It's like, you know what? It just absorbed like a 12 terabytes of data and performed 2 billion discrete examinations in a nanosecond. No, man, I'm not checking its math at that point. It's freaking way better than I am at.
Right.
We'll check to see if it didn't make a spelling mistake. It's like those symbols are all still there. Yeah, looks good. But nobody looks at it and says, I don't know, machine, Netflix is tough. I think I'd go Disney on that one. No way. Like, you just got to let that go. You're going to get outperformed.
Yeah, because we don't. Yeah, you don't have the capacity to go through all those computations and math formulas like the AI is doing almost instantaneously. Do you think this will cause a shift in the individuals / types of expertise investment firms will look for when they're hiring moving forward?
I do. There's already been a huge shift. I mean, if you look at sort of the granddaddy of all this Renaissance technologies, he's been doing this for 30 years. When Mike again asked what companies have this strategy or this technology, I guess is broadly what he's asking now. And you've got only a handful of firms are using this. Nobody's really talking about it, I guess, except for us. But Renaissance Technology has like 397 scientists and 5 traders. Like that's the skew at a shop like that. We certainly, our AI team outnumbers our traders like 3-to-1 or 4-to-1 or something like that at this point. You still need the trader because, once you get to a certain size, there are counterparty conversations that need to happen. Like, the machine sort of pops up an opportunity and says, you should trade this, you should sell this, you should buy it. And if it's not just, lit firing out equities on the floor, you got to call a desk somewhere. Like, hey, I'm pushing 1,500 of this, selling the meat. And there's a discussion that nobody's going to have with a machine. So you need the trader. The trader has to educate the technologists on the mechanics of the market, how it works, what's realistic to assume, not assume, especially when you're talking about wide spreads. So traders still have a role, but there will be fewer of them. AI data scientists, obviously, that's the top spot. Systematic and quant is going to go to the way of the dodo, but I don't know any quant traders that aren't moving into AI anyway. Like, they're super sharp people, so they're just going to make that migration. If they haven't already, they're going to make that migration. And static quant funds and quant managers will just go out the window.
That makes sense. I mean, making that transition to AI. Well, Ryan, what about risk management? How can AI help us better mitigate investment risk?
Well, it can certainly see more faster. And, we make extensive use of that. So, our ARC system, AI risk containment system, which is, one of the more massive systems that we run, that's essentially a holistic portfolio off-ramp mechanism. So it's watching all the positions that we have against their projected model trajectories. It's watching the entire stock market at the same time, and it's picking up minute correlations in risk across sectors, industries, in the equity itself, et cetera. And so it can sort of act as a bit of an early warning system, talking at all times with our regime classification and change detection engines. And those three together sort of collaborate to keep us safe. So if classification has a high degree of certainty that this is the regime that it's in and it's happy with that, and change detection says, yeah, I don't really see anything else coming, the ARC will look at that and say, yeah, this is low risk, I don't see anything there. But when classification says, I don't know, and change detection says, I have no idea, then the ARC gets vastly more aggressive and will look to mitigate risk, minimize positions, offload, add net long units, et cetera, make those kinds of decisions.
Understood. Ryan, given that the AI-powered strategies have the ability to see the whole picture when it comes to investment decision-making, how can we on the human side of the equation better account for our own preconceptions and inability to see the total picture?
It's a big question. Big question. How can we compensate? I mean, we're not going to compete at a technical level, but we don't really need to compete at a technical level. I mean, it's useful to know the systems are there. It's useful to know that they have predatory behavior built in. So if the machine is not primarily predating off of trading behavior signals that it sees, some of the bigger systems, I would venture, say, something the size of Citadels or Wellington, something like that, is going to be able to manage its own order flow to trigger behaviors that it knows will follow that order flow. So, for example, yeah, if it's okay, so I hate on MACD, right? And if it's a fan favorite retail trader buy sell signal, it's manipulated all the time, because institutions know that retail traders will totally fire off an order on a crossover. So if the crossover is close and it can, through its own order flow, which it's important to note is not market manipulation, they're actually participating in buying and selling, that's totally legal. If they can push order flow out that will cause that crossover and then reverse the trade, they'll do that. And so you need to know that that's there and that you're being targeted on some level. So maybe don't, use 5, 6 different criteria to validate your entry and exits, not just your favorite crossover signal. That's something that's low hanging fruit for them. In time, I totally think that these tools will make their way largely down to retail. Like there's going to be sort of autonomous trade identification systems, risk management systems, risk calculators that I really hope that the average retail trader can be like, I'm thinking of making this trade. You plug it in and you could get like a historical probability that this ever would have worked or might work in the future. That would be useful. I'd love to see those tools. Right now, unfortunately, no one's building those.
Well, it sounds like, Ryan, kind of the gist of our conversation today is that use AI for the things that it's good at, things that we humans can't do. But at the end of the day, at least right now, us humans are still needed to help make these final investment decisions. And in certain cases, like a black swan event, COVID crash, you're going to need humans to be able to interpret all the news and things that are happening right now, because models may not be built based on something that hasn't happened yet. As always, it's been a fantastic conversation learning more about AI and how it will impact our investing moving forward. Do you have any final thoughts you want to leave us with today?
I think, a couple of different things. I can quickly answer a couple of these questions here.
Yeah.
Mike says Renaissance, a huge hedge fund using quant models. It's actually employee owned, and quant was where they started, but they've been machine learning faced for like the last 15 years. They in fact modeled missing commodities data that they didn't have from the 40s. It's kind of crazy, but nobody's getting any information out of that shop because they also have the distinction of having the highest number of millionaire receptionists in the world. So there you go. Good luck getting anything out of that. I don't think anyone would share the secrets of a 70% net of all fees shop. In terms of access, like I said, and you've got a question here. You've got how many individual traders benefit from your data and models. I wish that was something we were allowed to provide. It sort of is one of our big complaints. Regulatory restrictions right now have just not remotely caught up to this technology. So, transparency, disseminating KPIs, saying, hey, this is how we do what we do. Hey, these are models that you should consider looking at. Not even allowed to share that if we wanted to, because they consider it a quantitative back test. So final thoughts. I definitely would be careful of using generative AI, anything other than basic heavy lifting. I think probably most of your viewers are already know that. In terms of predictive AI, it's going to come, but there'll be two flavors, right? There'll be the robo-advisor style, which I would be very, very, very careful with. That's going to be lots of AI washing, despite the SEC's warnings. And they'll be looking for like, hey, invest money with us, and the AI will just take care of it for there. You don't want that. You want tools that make it easier for you to do your job. Find me stocks that do this, scanning tools, right, risk tools. Show me when I should exit this based on these things. That's what you're looking for. In the end, I think it's reasonable to be optimistic about what AI is going to bring. Sadly, right now, it's a little slow on the retail side and being a bit hoarded by the institutional side.
Yeah, I think typically with new technologies, that's how it goes, right? The big guys get it first, then we'll wait for our access to kind of trickle down to the retail investor. But hey, companies like Kaiju are making it easier for retail investors to get exposure to that world. Well, Ryan, thank you again for hopping on. Always great to catch up with you. We got to do it again soon, I think in a couple weeks, right?
Absolutely. Always happy to be here. And thanks to your viewers here for asking good questions.
Yeah, they came with it today. All right, good job, guys. We will be back here in a couple of weeks with Ryan. Ryan, enjoy the rest of your day.
Thanks, Aaron. Take care.